Everyone. Speaker of the day Khushru Panthaki, Vice President Chetan, the incoming convener of the Accounting Auditing Committee Chirag Doshi, past presidents Kanubhai, Pranay, Mr. Narang, all the seniors, professionals and student friends, welcome to this lecture meeting. Before we start this lecture meeting, we will release the BCA's referencer. I would rather call it the first and the original referencer, and today it's in its 54th year of publication, perhaps the oldest publication of the society. And definitely it's a proud moment for the Membership and Public Relations Committee, and I'll request Chairman Naushad Panjwani to tell us more about it.
Congrats for using the word original referencer. Good evening. I'm sure we are seeing a packed house, not for the release of the referencer, but to hear Khushru over here. So we'll keep this function bare minimum, but it's an important function. As President mentioned, this is the 54th continuous year of a publication which has come in the professional life of so many of us, and it has become a tool without which most of us cannot function. It has been our responsibility to upgrade, taking a cue from what President said, the original, because the others need a chance to upgrade themselves also. So unless we don't upgrade, how will they copy? So it's been upgraded periodically, and now with the kind of technological changes that are happening and at the speed that are happening, we are also upgraded the technical aspects. So this year again, it will be available in the app form, it will be available on the website, and even the hard copy has been condensed and made into a different kind of format, which I'm going to request Pranay Bhai to come and speak about. And on that cue, what I would like to do is I'd like to invite our past president, Mr. Pranay Marfatia, who has been associated with this publication for God knows how many years. I was an editor of the publication about 15-18 years back, and at that time he was the chairman. And I think it's befitting that he come and speaks about the referencer and acknowledges the contribution of everybody who has participated in bringing this out. With these words, let me welcome Pranay Marfatia on dais. Please welcome him, friends.
Thank you, Naushad, for giving me this opportunity. As Naushad has already informed that I am associating, and I am proud to be associated with this release function as a part of a BCA members, BCA core group members. As mentioned, this is the 54th continuous year of publication, year after year without interruption. And as I would put it, all credit goes to the dedicated compilers, without whose efforts this heroic task is not possible. 57 compilers made these efforts to make this in a booklet form. And so the first credit goes to the compilers for their self-commitment to the cause. And as Chairman has mentioned, with the change in time, attempt has been made to revamp the presentation that we'll be able to see when the book will be released at the hands of the today's chief judge function. And to be in line with the technology, as Chairman has said, reference will be now available on apps on Android users, iPhone users and desktop user also, and it will be available in web also. A special password will be given on each book of the referencer, and on the using of this password that can be available on your iPhone also, or your Android smartphone also, or on a web also. And this time, for the first time, we are also coming out with the e-diary on the iPhone and Android users. That will be there. That will be available from 1st of July. And apart from the compilers, as I have put it, for these efforts, special thanks to the team of editors for making all the things to the extent possible, make correction. We admit that in such human task there will be some mistake, but what I would request after going to the referencer, if any technical or any something error is fine, please do in touch with us, so in the future we can surely improve upon the things, and things can be improved for the better in the future. So, well, and as before, I would request Mr. Khushru Panthaki to release the publication. I would think that before some years we have started with the theme, and this year theme we have Make in India as the theme with our popular Prime Minister Narendra Modi has started, and we have computed a microscope of growing sectors in India from agriculture, banking, e-commerce and retailers, industry, infrastructure, etc. to give an indication of the growth prospects expected in the near future. Much like our referencer, which presents a microscope of the most important areas of professional importance while providing insights and giving glimpses of way ahead. So with these words, I would request Mr. Khusro Pantaki to release the much awaited publication, but I would request that this publication is being released today, but will be available for the advance booking those who have made and across the counter from Monday 20th June 2016 onwards. So please bear with us for 3-4 days because of the coming of all this quantity from the printer takes 2-3 days time. So that will be from Monday 20th June it will be available. Now I would request Mr. Khusro Pantaki and all other President, Vice President, and I would request the editor also to join, Mr. Yatin who is here. Rajiv is also supposed to be here. Rajiv is also here to join. And now I would request Mr. Pantaki to give to the two editors whose efforts have been made this referencer possible. So I would request Yatin and Rajiv to get the copy from his end. I also recognize presence of some of the compilers, Mr. B.V. Javeri is a senior person, Mr. Abhay Mehta, and all other person, Manish, Deepak Shah. Deepak Shah, also past president, has also contributed a lot to these references, so I'll thank him also on these things. And friends, as a revamp, as I had said, it has been totally, this time, as you must be aware, those who are using the referencer, till last year, there were so many different types of product. Now it is only one referencer product. There are no different type of products which is available. So I hope you will like it. And as I said, it will be available for Monday. Thank you very much for giving me this opportunity. Thanks a lot. And I am happy to inform you that this advance release booking, more than 3,000 copies have already been booked for these referencers, and the balance which will be available from sale from Monday onward. 3,000 has already been. Thanks for response. Thank you very much.
Thank you, Pranay bhai. Thank you, Naushad. Thank you, all the editors and all the compilers. It's a huge amount of effort to do this voluntarily year after year, and I know that there are so many people who give their selfless service year after year, keeping and upholding the quality of their work up to the best possible level that they can. So welcome to this lecture meeting, recent regulatory issues impacting in the audit finalization for the year ended 31st March 2016. The Bombay Chartered Accountants Society arranges free public lecture meetings about twice a month, in addition to other professional educational programs that it does on an ongoing basis. This last Wednesday, we had a similar lecture on ITR filing, and the next week, we are going to have a talk on the bankruptcy code. Today, as far as the public accounting practice is concerned, specifically in the area of statutory auditing, the regulatory environment is as dynamic as it is treacherous. Earlier, we would call something as audit risk, the risk you carry in doing and signing off the audit report. I guess now we can call it audit hazard, and you will know what I mean after you hear Khushru. Statutory audit practice by chartered accountants has dimensions that are really vast, complex, and intricately interwoven. When we look at last 10-15 years, the difference between what one had to consider then and what one has to look at now is exponentially different. The number of accounting standards, and shortly you will have 2 sets to deal with, are at their peak. The potentiality of legal non-compliance impacting financial statements remains very high. Each year, the auditor's report requirements have been expanding. We had CARO 2015, today we have CARO 2016. The format of audit report keeps changing. We have seen several guidance notes coming in and even withdrawn or replaced. We had guidance note on depreciation revised recently. We have the guidance note on many other topics that have come in during this year. And of course, how can you miss the supernova, an exploding star amongst the star-studded sky of guidance notes, that is the guidance note on audit of internal financial controls, reporting over internal financial controls. The 200-page guidance note, which is bundled with a CD that has tons of formats. Additionally, the standards on auditing, about 1,000+ pages of material that an auditor is supposed to have complied with. And when he signs his or her audit report under the Companies Act, he's saying, I have complied with all those standards. I'm sure you are all aware that the standards are now having full legal force under the Companies Act. And here there are no carve-outs nor any special exemptions such as those for SMCs and non-SMCs like we have for accounting standards. My fear is the day our babus decide to wonder whether the auditors, are they following the standards on auditing? Let's check it out. That day will be the beginning of trouble for auditors. And I'm not talking about people who are not complying the standards on auditing at all. But because of the sheer subjectivity that is built in within those standards, where one can interpret it in many different ways, all chartered accountants and all practicing within the audit profession are carrying a major amount of risk. Finally, the expectations from auditors increasing in quantum and expanding in scope. Be it from administrators, politicians, or public at large, the expectations are only increasing every year. When you look at the full spectrum of expectation from auditors, you will know that you are under the spotlight each time you sign off and it's uploaded on the MCA website. Your audit report is under the spotlight. In that sense, an audit is no longer a professional task, but also an act of professional bravery, I would say. Friends, where everything is increasing except the time available to decipher and cope up with the changing regulatory landscape, we are all here to listen to the most important aspects that we need to look at very carefully for this year end. And we are going to listen about it from Mr. Khushru Panthaki. It's a brush up, a refresher sprinkled with a tinge of fear to up our attention on key points that you need to consider. In the next 75 to 90 minutes, Khushru will tell you that all those things that you really need to focus on when you sign off on the audit report. Before I introduce Khushru, I may request people, if they find any space around here, please feel free to sit down and make yourself comfortable. I'm sorry for not having enough space. but this was the hall that was available today. So if you find any space here and you don't mind, please take a seat. You can even sit down here. It'll be, trust me, it'll be more comfortable.
Someone wants to sit on the stage.
Yes. So brief introduction of Khushru. 1 minute. Khushru has been in practice for 31 years. He is a senior audit partner in a well-known accounting and consultancy firm, and he also heads the BFSI segment. His experience is extensive, and that you will find out shortly once he starts talking, both locally and internationally. He has completed a diploma in insurance from Darden Business School in Virginia, apart from being a chartered accountant and a commerce graduate from Sydenham College. He has many other degrees. He has given papers, talks, seminar in India and overseas. And last year was his first lecture meeting at BCA, and it was just like this one. The view was more or less same. That was his 223rd lecture meeting. And when I asked him right now, this I believe is his 248th lecture meeting. So friends, before I request you to welcome him, I will request Vice President Chetan to give a memento as a mark of our appreciation. And I request you all to welcome Khushru.
Very good evening to all of you. At the outset, my sincere thanks to BCA, Raman, and everybody over here for giving me this opportunity. I would rather now take the liberty of saying annual opportunity, because I remember the last time when I spoke, it was 12th of August 2015, a little bit late when you think about the audit season for 31st March 2015. But this time it is the audit season of 31st March 2016, and we are right on time in terms of the month being June. Rain gods have not done much of a favor this time, so I can see a good amount of crowd, and I'm completely overwhelmed by the fact that this room has no space to breathe as well. So I really appreciate the audience. Thank you. And I'm very, very happy to see a lot of young faces who are students, I believe. And I still remember very clearly that when I was an article trainee from the period 1984 to 1987, I remember having attended a few programs over here. I was like one of you at that point of time, and I'm very sure that some of you will have the privilege of being on this side, maybe 10, 15 years down the line. So always a pleasure to address a fraternity. I have been doing this in the past 20 years now, and I always like to share my experience, and I always like to share the kind of joy that I derive from being an auditor. Now, I would like to put the subject in perspective, and I'll take about 5-10 minutes to put the subject in perspective. But I would also like to thank the BCA for giving me this wonderful opportunity to inaugurate the referencer, the original referencer. It's a privilege very few will have, and I've had it today, so I'm very overwhelmed on that, and I thank again BCA for that. Friends, audit seems to be a very boring word. That was always the case when we used to think about audit. I'm very sure that many of you, with due respect, who come from the tax practice or who come from a different practice may still think that what is there in audit? We just have to tick who sees, who checks. And therefore, I think whatever it is, we need to just sign off, and we need to just make sure that the fees are recovered. As Raman rightly said, audit is not just a profession, it is now becoming a hazard. And I would not want to begin on a note which will scare everybody, but just the fact that I can keep reiterating, because I spoke on a similar subject last year. At that point of time, it was audit finalization for March 15. Now we are talking about audit finalization for March 16. And my suggestion over here is that please do not take audit lightly. You have been reading in the papers the kind of focus the auditors have been getting over the past few years. Not just the auditors, but even the consultants who are involved in some of the engagements and the professional work that they do for corporates. we have very strict regulators. I remember my era between 1984 and 87 when I was an article trainee. There was nothing like a whip from the regulator. You look at it now. The regulator is right standing out there with a whip, whether it is the Reserve Bank of India or the IRDA or the SEBI or the Ministry of Corporate Affairs. Firms go through a lot of inspections. Peer reviews are becoming much more stricter. Firms which are auditing listed companies have to undergo the process of peer review. They know exactly what it is. Documentation is of paramount importance. And I believe audit is no longer a joke. Audit is no longer something that can be taken lightly. We need to be completely abreast with the latest developments. And these latest developments keep happening every year. Last year, I thought that Caro 2015, which has come back after so many years, will be there for some time. It's replaced. And things will keep replacing again and again. On one hand, we are saying that we are trying to be converging with the Western standards in terms of accounting and auditing. On the other hand, our audit reports are becoming longer and longer. I'm not a critic over here as far as the regulatory environment is concerned, but we are the only country in the world which has an audit report running into 5-6 pages, and it keeps evolving all the time. If you look at the audit reports under international audit standards or under the US GAS, it's hardly 1 page or half a page. But why is it that in India we have such long requirements of reporting? The reason being, and very factually, the reason being, with due respect, that the government does not trust as far as the transparency of corporates is concerned in terms of reporting. Corporates are required to report, but they believe and they trust the professional like auditors, like chartered accountants, where they are very sure that whatever has been required to be reported, that will be reported. So you can understand that we are held in very high esteem. We have a very major responsibility, a sense of duty and ownership to ensure that things are rightly reported and not misstated in the audit report. That's the reason why we are called as auditors. We are one of the most respected professionals in the country and internationally. I have worked in the UK and in the US, and I can tell you that as an Indian chartered accountant, we get a lot of respect because people know the kind of rigor we go through in terms of examinations, in terms of clearing the course, in terms of getting the professional aptitudes. The other thing which I thought that I would like to share is that if you are an auditor, you need to know your standards very well. There will be so many things and there is a lot of general knowledge, but there is something called hardcore standards, and these are hardcore auditing standards. With my hand on my heart, I can tell you that the awareness and the knowledge of the auditing standards in India and internationally is much lower than the awareness of the auditing standards, awareness of the accounting standards. We all love the accounting standards. We like to understand different things on the accounting, but the knowledge is very, very poor on the auditing standards. It's just because of the fact that professionals like me and many, many others in the past have never understood the importance and have never even read the standards. But look at it, the way the auditing standards have been evolving. They are much more faster evolving than the accounting standards. And these are the standards that you need to know thoroughly if you want to be in the auditing profession. The second thing that I would like to tell you as an auditor, please be responsible of the fact that you have a duty to be independent, a responsibility and a right to be independent. And you may think that, this guy again speaks the same thing what he said last year. I'm sure that 20% of the people over here or 30% of the people over here were present last year. As Raman rightly mentioned, that this is a revision, and I keep reiterating some important points. You need to be fully independent as an auditor. Professional services that you can deliver as an auditor, which are permissible, can be done. Otherwise, you need to be completely independent. You and your family members need to be independent. You need to be sure that whatever you are doing in terms of other services will not impair your independence as an auditor. I'm completely aware that smaller firms are definitely having a difficult living, and they would like to write the books of accounts, close the books of accounts, audit the books of accounts, and report on the fact that everything is fine. Well, that could be the case. You're not doing anything wrong, but the professional standards would not permit you to do that. As far as audit fees are concerned also, I can tell you that please make sure, and I'll come back to that later when I'm talking about internal control over financial reporting, that please make sure that you are doing a diligent job. You are signing financial statements. It's the most risky thing that you are doing. You need to be adequately rewarded. This is not a commodity or a service available off the shelf that you would want to deliver and you would not want it to be compensated fairly. So the other thing that I would come back to you will be on the services front and the kind of fees that you need to have. So friends, I think as a profession, we have evolved and we need to continuously be updated on specific things. I would request you on a couple of things. Please park your questions on the paper because I would not want to be interrupted during the session. I'll be more than happy because the time is very limited. It's only 90 minutes that I have over here and then about 10 minutes for question answer session. So please park your question and I will make sure that I give my best attempt to respond to those questions. Second thing is my sincere request, please keep your mobile phones either on the off mode or on the silent mode. It distracts the speaker, it distracts others as well. And in case if you need to attend to the call, please, you can go out and attend the call. Audit also remains with many compliances. I remember when I used to do the audits earlier, compliances were not that very important. We used to just do the audit, sign off on the financial statements and walk out and recover the fees. These days, compliances are significant. If you look at Caro also, Caro requires the auditors to comply on specific aspects, which are very, very stringent as well. The new standards are going to be in place. I think they are already in place for some of the large companies with a net worth of more than 500 crore. Ind AS is already come in existence. 30th June reporting will be under Ind AS. And therefore, we have to keep learning new accounting standards. We need to keep learning different things at all points of time. There is a Companies Amendment Act which keeps evolving every time, and therefore there are some regulations out there. So what I have done is that over the next few minutes, I will completely take you through some of the important provisions which have come in new. My presentation, don't get scared. I'm not trying to shoo people away from here, but don't get scared. My presentation is 110 slides. But we are not going to be covering all the 110. There are specific sections on SEBI. There are specific sections on Ind AS which are not completely relevant at this point of time. So if I'm going a little fast, if I'm skipping the slides, please be rest assured that we are not missing out important things which are relevant from a 31st March 2016 perspective. Now, when we talk about the audit and we talk about each season, I keep asking myself, have I improved this season compared to the earlier season? Sometimes the answer is yes, sometimes the answer is no. It all depends upon the extent of involvement of an individual who is a partner or a senior member of the team or any particular member of the team. I always tell my young article trainees in my organization that you guys are lucky. You guys are lucky because of the fact that you are born in an era where technology is of the highest importance, where you really learn and you are well trained in organizations. I very well remember 32 years back when I started my articleship, exactly 32 years back. There was nothing like a formal training. There was nothing like understanding the business and the control environment of an entity. So somebody will ask me, how did you do the audit? It was only a financial audit that I used to do. Sit down with the CFO, not even a CFO, there was no term like a CFO, finance manager or GM or whoever it is. Take the books, take the numbers, correct it with the vouchers, understand a few things, look at the trial balance, grouping, schedules, P&L, balance sheet, notes to accounts. That's it. The financial statements used to run. Even in those days, cash flow was not existing. Those days, we used to finish the audits, and the end deliverable for a listed company also will not be more than 15-20 pages. These days, the end deliverables is about 45-50 pages. And under Ind AS, it could be even 20% more because of the stringent disclosure requirements. These things need to be thoroughly reviewed by whoever it is insofar as his role on the audit is concerned. Trainees should never feel, and I can see a lot of young blood over here, trainees should never feel that they are the junior most members in the team and therefore the responsibility will be there on the senior members to cover the areas. Yes, they will be responsible, but you have a role to play. And under the stringent regulatory requirement, God forbid if there is a major error or if there is a blunder, the firm is questioned, the relevant partner is questioned, and then there are a lot of regulatory actions which go against the individual. These days, as you are aware, the institute not only will depart you for a period of 6 months from signing further accounts, but also will initiate disciplinary proceedings. And people have gone through that. You may come out of the disciplinary proceedings very nicely after 10 years or after 5 years or whatever, but your name and your image gets tarnished during that period of time, and that damage repair can never be done. So with this, I think I just set the tone in perspective. What we are planning to cover is Companies Act. Raman specifically asked me to cover the fraud reporting, which I'm doing. Some of the updates under Companies Act, Schedule 2, reporting on internal financial controls, a new animal which people are still not very clear about what needs to be done. The Caro 2016, which is again an evolution from the earlier periods. A small brief on the CSR, corporate social responsibility, some of the updates of SEBI, which I'm not going to take, but I've kept in the presentation because you will be able to view the presentation or take a copy and look at some of the SEBI updates as well. Some of the updates from the Institute of Chartered Accountants, and finally, a little bit update on the Ind AS, which is the future for accounting profession. So when I come to Companies Act, independence, as I talked about, independence is of paramount importance. Being a partner, being a team member, and your independent dependents as well. Don't ask me about the wife, is she dependent or independent? She may be independent from an income perspective, but she is considered to be a dependent. A spouse is considered to be a dependent, irrespective of whoever he or she is. So, insofar as the listed companies are concerned, the partner, the engagement team, and the dependents, which are now widely defined under the Companies Act 2013, unfortunately, again, brothers and sisters and son-in-law and daughter-in-law and uncles and everybody is covered. I really do not understand why. Only India has got these kind of independence restrictions which are much more stringent than the SEC and the PCOB regulations as well. So you need to be fully independent of the client. You cannot purchase securities, or you cannot purchase securities beyond a permissible amount. And you also need to ensure that none of the persons in the organization at a particular level is related to you. So if the CFO is your uncle or your auntie or whoever it is, then you need to be abstained from being a part of the engagement team, and you need to make sure that somebody else does the audit. So you please need to be independent. This is one question which keeps coming up in the peer review. And another thing which I would like to mention is that please make sure that if you are a part of a larger professional firm or even a mid-sized professional firm, an independence mail needs to be sent to your staff asking as to who is holding securities in the company and who has got specific relationships with individuals in the company. Those individuals who have securities, those individuals who have relationships should not be a part of the audit team. Under Companies Act 2013, only partners and their relatives and the spouses need to be independent, but generally the firms take a call that whoever works on the audit team need to be independent. Then, as I mentioned, there are certain restrictions on the services. As an auditor, you need to do the audit. Now, there are some permissible services and there are some non-permissible services. Let's come first to the permissible services. As an auditor, you can review the tax provision of the client, but you cannot start compiling the return of income. Now, I am going to tell you what the law is, what you are doing, and how you need to do it. Please don't ask me this question, okay, how do I structure the engagement letter, or how do I manage these things? What I'm saying over here is that, as an auditor, you have to audit, you can review the tax provision, you can review the tax return. You can represent insofar as the income tax matters is concerned up to the CIT appeals level. But please, you cannot, you nor any partner of the firm cannot sort of represent at the tribunal level or at the High Court level or at the Supreme Court level. That is impairment of independence because you are advocating for the client and the matters which have an impact on the financial reporting. And therefore, you will not be independent there. So what is it that you cannot do? Definitely, you cannot write the books of accounts. You cannot do the internal audit. I remember very clearly that there was a point of time when we were doing the internal audit and the statutory audit. Internal audit was done in a different firm name, statutory audit was done in a different firm name, and this can even happen today. You have 2 firms or 3 firms and one is doing A and another is doing B. A and B are conflicting services, but still you provide. Please make sure that this is not going to be happening in the future. You cannot be an internal auditor because if you are an internal auditor, then you are stepping into the shoes of the management, and that impairs your independence. Designing and implementing any financial system, because if you are designing and implementing the financial system, what is it that you would report on internal controls? You're completely not independent to report on the internal controls and systems. As an auditor, you cannot provide actuarial services because you are relying on the actuarial valuation done by an actuary, whether in the case of employee benefits or in the case of insurance companies on the policyholder liabilities. You cannot provide investment advisory services. Chalo, client ka IPO aa raha hai, let me provide investment advisory services. You can't do that if you are an auditor and you are attesting the financial statements. Investment banking, investment advisory, not permissible. Any outsourced financial services. My client is actually in trouble. Yeah, he wants the payroll to be done by me. He does not have enough staff. Chalo, main payroll kar lunga. I mean, I can do that. And I'm seeing a few faces smiling over here. So I'm very, very sure that there are hidden skeletons, but please make sure that payroll services are also not required to be, are not allowed to be provided if you are an auditor. And some of the management services. Now, Institute or maybe Ministry of Corporate Affairs is very widely written, management services. How do you take a call on this particular word, management services? You need to ask a simple question. If I'm an auditor, I'm providing an assurance function. If I have to do certification work, it is an attestation. If I have to do any kind of an attest work, it is basically giving a view, giving an opinion and attesting it. That will not impair your independence. Anything that you can do from an attestation perspective, and attestation is again being very clearly laid out in the auditing standards, is permissible as an auditor. The remaining services are not allowed. Another heads up I would like to give you, that please devise your audit fees in such a way, or please ask for the audit fees in such a way, that the total amount of the audit fee is higher than the fee for all the other services provided by you as an auditor or as a consultant. So if your audit fees is 5,000 rupees, the total fees for all the other services that you provide have to be below 5,000. If you go above 5,000, then in that particular case, your auditor's independence is impaired, because now you are less of an auditor and more of a consultant or more of a management. People are wondering, what am I talking here? This guy's gone nuts. But this is the facts of the case. You also need to make sure that as of 31st March, see, Companies Act came into existence from 1st April 2014. It allowed you for a period of 1 year to continue with all services that you are providing and discontinue everything effective 31st March 2015. As of today, you are sitting in June 2016. So effective 1st April 2015, you should not be providing any non-permissible services as an auditor to your clients. So please make sure that even if at all those were provided at some point of time, you will not be able to charge for those services. This is a little bit of a, sorry, from a font perspective, but I wanted to also emphasize on one aspect. Auditing has changed completely. I am very, very sure, with due respect, that many of you over here will still be going through the traditional approach of audit or a transaction-based approach of audit, where you are still sitting down with the invoices, with the vouchers, tallying these vouchers with the financial statements and the financial books of account, looking into the groupings, schedules, everything, which is fine. You are just doing a mechanical job of a transaction-based approach. You may be extracting a sample at random, which is not a true representative of the population. You are also actually not even aware that the statistical sampling techniques are there to ensure that the sample that you derive is a true representative of the population. You need to understand the audit methodology. You need to learn the audit methodology. If you are auditing a large company, I'm very sure that many of you, or 90% of you over here, may not be involved with the listed company's audit. I'm just presuming. But even as an auditor for a non-listed company or for a public interest entity which is not a listed company or even a private company, the rigor of the audit standards remain the same. The rigor in the audit will remain the same. There is no difference between how you would audit a listed company and how you would audit a non-listed company. Standards are 90% same applicable. And therefore you need to do the audit with the same kind of a rigor. And therefore the first thing that you need to understand and you need to do is understanding the business of the company and understanding the industry in which the company operates. Banking is different from insurance, which is different from IT, which is different from manufacturing, which is different from film production. They are all in different industries, and each industry has its own nuances. Each industry has its own specifications and specific aspects which you need to be aware of, because unless and until you are aware of the industry and the business of the company, you will never be able to do an effective audit. Unfortunately, the standard on knowledge of the company's business came in much, much later. This standard should have been there much before, because without the understanding of the business and the industry, you will not be able to do an audit. So how do you do an audit? You need to understand every key process of the company, every key function of the company, which is significantly responsible on financial statements. You need to meet the process owner or the head of that department. You need to understand how it operates. You need to identify what are the inherent risks in the business, in the processes. What are the control risks in that processes? You need to test those particular controls from an assessment perspective and to determine that whether you can slightly rely, rely to a great extent, or rely not at all. And then you need to carve out your audit procedures to make sure that you carry out the audit based upon the assessment of controls. Now, this particular approach has been there for many, many years. The only difference is that now you are compelled and you are required to test the internal controls because of the fact that there is a new requirement of internal financial controls over financial reporting. So all these things have to be done in a particular manner. The standards are very, very clear. And if at all you follow this particular approach, which I have given in the flow chart, then you are actually following a risk-based approach. Once you have this particular risk-based approach, you have to complete the audit. And once you complete the audit, I'll come to that later, you need to report the observations to individuals who are charged with governance. In the case of a listed company, there is an audit committee. In the case of unlisted company, there is board of directors, and those people need to be communicated. You will be shocked to hear, and I'll take that through in the presentation, that there is a new standard now, 701, applicable from 1st April 2017, which says that significant matters or observations of significance even need to be reported in the audit report. And that is actually going to change the complete reporting perspective. That until now we had a standard audit report, now that particular audit report requires to report on specific observations or significant observations. I'm not saying it's ridiculous, but I'm just saying that, does it make sense? But that's something which we will cross the bridge when it comes. It is from 1st April 2017. So this is the kind of rigor that is required in the audit. Coming to Companies Act 2013, some of the important matters. 31st March is a year end. For subsidiaries and for holding companies specifically have got foreign collaborations, etc. You can have a different year end provided that you take the approval from the central government to that effect. Consolidation is mandatory now for all the companies. I remember we used to do consolidation only for listed companies once upon a time. Now it's mandatory. It became mandatory last year itself. So 31st March 2015. You were doing the consolidation for even private companies, but then there were certain exemptions at that point of time. Those exemptions were that in case, if at all, the company only has a joint venture or an associate, then you were not required to do the audit of consolidation at that point of time, or you were not required to prepare consolidated financial statements. Even at that point of time, if the company has a foreign subsidiary, even one foreign subsidiary, you are not required to do the consolidation. If you're doing it, it's great, but if you're not required to do, you were not required to do. Now things have changed. For 31st March 2016, consolidation is mandatory for everybody, private, public, not listed, listed, irrespective of whether the company only has a joint venture and associate, irrespective of whether the company has a foreign subsidiary or not. So now no more excuses, no more relaxations. Consolidation is mandatory, and the audit of consolidation is also required to be done. Minority interest is required to be shown separately under the schedule of equity, which you have it now. And in the case of financial statements, which are consolidated financial statements, please provide disclosures as necessary and as relevant. Coming to the consolidated financial statements, I mentioned earlier it's mandatory for all the companies. We took you through earlier on this. Even the consolidation is done in accordance with the provisions of Schedule 3 of the Companies Act, which is now replacing erstwhile Schedule 6. You had Schedule 6 under the Companies Act 1956, now you have Schedule 3, and you need to prepare consolidation in accordance with the requirements of Schedule 3. You may have seen some companies in the past where the listed companies were allowed to do consolidation under IFRS. It was not even mandatory for them at that point of time to do the consolidation under Indian GAAP. You look at some of the companies in the past like Glenmark, like Infosys, earlier years, March 14, March 13, you will see the consolidated financial statements prepared under IFRS, not prepared under Indian GAAP. Now that requirement is gone. Currently, Ind AS now will be applicable for the first time for March 2017, but till 31st March 2016 and for 31st March 2015 as well, consolidation is only required to be done under Indian GAAP and will not be allowed to be done only under IFRS. If you are disclosing it under IFRS additionally, then there is no problem, but you have to do only under Indian GAAP. We've taken up this earlier, so there's no problem on that. How we can professionally support. If you are not an auditor of a company, this is a very good opportunity, and I wanted to specifically emphasize on this, that if you are not an auditor of the company, I'm sure that your clients will be struggling for the very first time to do a consolidation. They may not be having the right understanding. They may not be having the right tools to do the consolidation, so you can help them in doing a consolidation. But remember one thing, that foreign subsidiaries and other subsidiaries who are not following accounting policies consistently with the parent company, you need to convert them under the accounting policies of the parent company. You need to convert everything under Indian GAAP, and then you need to do the consolidation. This is an effort, and that is why professionals can definitely contribute and help the companies in doing an effective consolidation, so that when the auditors are actually reviewing that consolidation or auditing that consolidation, they do not come across major issues. Fraud reporting. I have to go fast because there is a lot of things, so please bear with me. If I'm going too fast, please stop me. I'll start going a little slow. There is a Companies Amendment Act. Unfortunately, this Companies Amendment Act in December 2015 has given rest to a speculation. There was no clarity earlier that what kind of frauds need to be reported to the central government by the statutory auditors. Now, first of all, let me put the subject in perspective that it is not the duty of the auditor to detect the fraud. Please be sure of the fact that you are not responsible for detecting a fraud. However, your procedures have to be stringent and cumbersome in accordance with the standards, so that in case, if at all, there is a risk which can lead to a misstatement on account of the fraud, that particular risk is mitigated by ensuring that you are aware of the conditions which are susceptible to fraud. Which means that in the event, for example, if the company is not preparing bank reconciliations on time, if it is not reconciling the debtors with its statements or whatever, then in that particular case, a fraud can seep through in the financial statements or in the books. And therefore, you need to be very, very sure that you carry out proper audit procedures. Now, one ambiguity which was there is that if the auditor has got reason to believe, and that is exactly the wording in the guidance note and in the standard, if the auditor has reason to believe that a fraud has occurred or in the process of being occurred, then in that particular case, you need to inform those who are charged with governance. Earlier, there was no particular limit set out. That means even if there is a fraud of a minor amount which the auditor has detected, would it be required to be reported? And the answer was yes. Of course, one can take a view, okay, a fraud of 10,000 or 20,000 in a turnover of 100 crore is not material. But the law did not permit you to do that. Fortunately, there is a clarity now. And it says that if the fraud is detected by the auditor, or if it is concluded that this particular matter is a fraud, then the auditor will have to inform the central government. Fortunately, it says very clearly that it is individual amount either of 1 crore or above 1 crore. So if you come across a fraud, or if at all you have a reason to believe or you are suspicious that there is a particular fraud involving 1 crore and above, then that matter needs to be reported. Now, there is a procedure for that. You cannot just report to the central government. First of all, when you have a reason to believe that there can be a fraud, you need to inform the audit committee, the CFO, the board. And it says that you need to inform within a period of 2 days. So you only have assessment of 2 days. Now there is a change. Earlier there was no specific requirement. Then the board or the audit committee will have a period of about 45 days to do the investigation, to come with the report, and to conclude as to whether it is a fraud or not a fraud. When they come back to you in 45 days' time, you have another 15 days to report that particular matter to the central government, to the Ministry of Corporate Affairs under a particular form. And therefore, this particular matter needs to be taken up very seriously. So please make sure that you do your duty. You are not investigating a fraud, you are not detecting a fraud. But if you are suspicious and if you have reasons to believe that there is a potential fraud, you give it to the audit committee, you inform them in writing. Please make sure that these are in writing, because it needs evidence of the date on which you are communicating. You have that period of 45 days. Audit committee may take 10 days more, doesn't matter. You give them 55 days, but then you only have got 5 days more to report and not 15 days, because the total period by which you need to report the fraud to the central government is 60 days from the day on which you communicate this to the audit committee. So this is of paramount importance. And you need to make sure that the audit committee has completed the investigation, and they are aware of the fact that what is the repercussion on the financial statements, is the amount material, what is the kind of recovery that the audit committee has expected from the person who has committed the fraud, what kind of penal action has the person has a company initiated against the individual who has committed the fraud. And it's very important that you get a complete picture of that, including the fact that is this amount adjusted in the financials or not. Once you are comfortable, you need to report the fraud to the government. What government will do later is not your problem, but you need to complete this particular aspect. Once again, I come back to the fact that it should be for an amount of more than 1 crore. If the amount is less than 1 crore, you are not required to report to the central government, but you are required to report to the people who are charged with governance. Again, audit committee, financial controller, financial officer, board members need to be reported. Now, what may happen? This happens very often. what may happen that you have reported to the audit committee, the audit committee has not come back. On the 58th day also, it's not come back. You need to tell them very clearly. And in case if they don't come back, on the 59th day, you report to the central government saying that this is the matter which I have referred to the audit committee. We believe it's a fraud. Audit committee has not come back. And central government will then initiate its own inquiry and proceeding against the company. So please make sure that you follow this particular procedure, because in case if you do not comply with this, the penalty can go anywhere between 1 lakh rupees and 25 lakh rupees for the auditor. Your fee will not be even 2.5 lakhs, but you need to pay a penalty of 25 lakhs for that. I have actually outlined over here, I think this presentation will be shared with you. I have outlined over here very clearly whose responsibility is on reporting of fraud, whose responsibility is on investigation of the fraud, whose responsibility is of detecting the fraud. As I mentioned earlier, you only need to report frauds which are detected by you. In the event that the frauds are detected by the management, then you are not required to report those frauds to the central government. You need to only make sure that the frauds detected by the management have been brought to the attention of the audit committee, have been discussed with the management, and the financial implications are sitting in the financial statements of such frauds. So that's again from your perspective that how these matters will be dealt with. Some of the Companies Act updates. Effective 14th of December, the Ministry of Corporate Affairs actually came out with the amendment to the Companies Act, and I think the bill is still there. It's not become an act, it's not received the assent of the Parliament, but you will be following these regulations. It has now really simplified the entire issue of related party transactions. If you remember, at some point of time in the past, many audit committees used to take the complete headache of approving each and every related party transaction. The board had to sort of approve those transactions or ratify those transactions. It was becoming a nuisance, it was becoming a pain, because some related party transactions can be of routine nature, can be within the normal course of business, will be at arm's length, but the government was becoming very harsh and very hard by saying that each and everything has to be approved. Now the amendment says very clearly, but I'm just saying this, it's not the law of the land as yet, it is only a bill. It will receive the assent of the Parliament and the President, but now it says very clearly that the audit committee or the board can give an omnibus approval, a blanket approval for related party transactions. So let's say that if I am buying from my subsidiary or selling to a holding company, hypothetically, these are the transactions in the normal course of business. They are at arm's length. They are at a particular price, which I will be offering to other companies also. They are done with proper KYC and everything else. So these are fine. These are related party transactions. Rather than taking individual approval or seeking individual approval, let's take an approval from the audit committee, a blanket approval for the entire period of only 1 year, including the fact that what is it in terms of nature, what is it in terms of amount. So the criteria need to be established. And the establishment of the criteria is left to the discretion of the audit committee and the board. So they can decide the criteria. Okay, chalo, all transactions below 1 lakh or 5 lakhs will be fine, will be ratified by the audit committee or the board at a later date, but you are required to take that omnibus approval. But this omnibus approval will be only for a period of 1 year. And the omnibus approval is only for the transactions in the normal course of business. In the event that there is a major thing happening, for example, a subsidiary company is selling off a particular division, or a holding company is making an acquisition of another division. Now, those are related party transactions, not in the ordinary course of business. And therefore, automatically you are required to take prior approval of the audit committee and the board, and sometimes even the shareholders as well. So this is actually eased out the business ease in doing the business in India, what we say, it's eased out of doing business here. Then there are certain amendments under the Companies Bill, which is basically Companies Amendment Bill 2016. It has come out with many amendments. You have seen the kind of discrepancies that were there under the Companies Act in terms of something is said in Companies Act, it's different under the RBI regulations, it's different under SEBI. A lot of these sections are now being streamlined. So if you look at it, on the 1st of February 2016, the Ministry of 15, what is now the new requirement under Caro 16, and what is the change? I have already briefed, so I'll just quickly go through the next one. CSR, I only wanted to say one thing, that many companies, we are aware about the CSR regulations, we are aware about the fact that 2% of the profits have to be given to charitable causes, CSR causes. Friends, remember one thing. This I have seen in many companies. First of all, in the case of a listed company or in the case of a public company, there has to be a CSR committee. There has to be a policy of CSR. What the company proposes to do, which are the institutions which have been recognized CSR institutions? Has the company completed a credit appraisal, or has the company carried out a KYC, or has the company actually carried out some kind of an investigation about the genuineness of those parties? Are those listed parties? Are those unlisted parties? Are those recognized parties? CSR is meant for community as a whole. Corporate social responsibility for the community as a whole. If the company has incurred an expenditure for the benefit of the employees, in terms of providing education to their children or hospitalization expenses or whatever, those are not CSR activities because these are confined to the employees. CSR is for the community as a whole. So if a company has built up an hospital in its own township, where the employees and others are also allowed to come and actually avail the facilities, it is a CSR expenditure. Many large corporates, 2% of the profits can be 200 crores, can be 20 crores, 30 crores, 40 crores each year. You look at companies, on an average, the profit is about 1,000 crore. 2% of the profit is 20 crore. Now, many a times, the companies may not want to incur a CSR expenditure because they may not be ready. This has a principle which is applicable in other countries as well as UK, which says very clearly that in the event that you incur a CSR expenditure, fine, you need to consider in accordance with the provisions of the Act. But in the event that you are not incurring an expenditure, provided that you still have the profits or you may not have the profits, you please make a disclosure in the annual report that this year you are not incurring a CSR expenditure because of these reasons. You may not want to commit that you will incur the expenditure in the future years for this year as well. But in case if you are confident that you will catch up in the future for this year and the future years, you can even make that disclosure. Corporate social responsibility requires adequate disclosure if the expenditure is not incurred. And the other thing which is an important change over here is the fact that many companies are actually establishing their own trusts. They are actually having their own bodies created. Now it says very clearly that if in the event that you want to create your own trust or your own body to carry out the CSR activities, then those will be required to be there in existence, carrying out such activities for a period of minimum 3 years. Which means that you cannot catch any altu-faltu company or create any altu-faltu company or start contributing to some of the politician companies which are newly formed in existence where you can say that the CSR activities are happening. These are the measures being taken by the government to ensure that whatever has to go back to the society has to go back to the society, to the larger community in the most effective manner. And therefore, this is one of the important provisions under the Companies Act now. SEBI updates, I'm not going through that because I believe we have missed the season of 31st May for reporting on listed companies. So it is there. It is there as a part of the presentation. When you actually start auditing for next year, it will be important. Coming to some of the Institute of Chartered Accountants updates, I just wanted to spend a minute on each of these standards. I had taken these standards in detail last year. I just thought I will take up one more time. In terms of auditing standard 700, friends, this is the most important standard because this actually carves out the format of your audit report. This gives you the format of the audit report. And therefore, you need to understand the standard thoroughly well. It's very simple. This does not talk about any qualifications or any modifications. It just talks about how the audit report should be. What is the responsibility of the management? What is the responsibility of the auditor? And it is not applicable from now. It has been applicable from 1st April 2012. It says that you as an auditor need to obtain sufficient appropriate audit evidence. You need to keep your documentation of work papers, and you need to make sure that you have carried out the audit in accordance with the auditing standards. So that is my 700. Also, it's important for you, please be careful of one front, that it says that the financial statements have to be signed off in the name of the firm and in the name of the partner. 90% of the time we see that the financial statements are just signed off by the partner. The firm name will be there, but the physical signature will be only of a partner. Please make sure that you sign off in your firm name physically, if your firm name is ABC and Co., you need to sign off as ABC and Co. And if you are Mr. ABC yourself, you need to sign off as ABC as well. So this is an important requirement. Please make sure. Some queries have come under the reporting by QRB as to why the partner is not signing off in the firm name. So I'm just giving you a heads up as well. Coming to the next one, which is 705. 705 is about modifications, it's about qualification, and I will take only a minute. Let's take up a scenario. Under what circumstances would you qualify or would you modify your audit report? Now we don't use the word qualification, we use the word modification. Earlier we used to use the word qualification. Now there are three different types of modifications. One is a normal qualification, not to be much worried. Another is a disclaimer of opinion. That means that you are not giving an opinion, you are disclaiming. You cannot opine because you do not have enough audit evidence to give an opinion. And the third one is a danger one. I call it as a real danger, and that is an adverse opinion. Adverse opinion kills the company and kills the audit firm both, because there will be a lot of regulatory inquiries, there will be a lot of issues. Now, what would lead to a qualified opinion? There are two circumstances which will lead to a qualified opinion. One is, you have all the information available with you, but you believe that the financial statements are misstated. Adjustments have to go through. Adjustments can be quantified, but the adjustments have not gone through in the financial statement. So it is a simple qualification. For example, undervaluation of inventory, overvaluation of inventory, under provision of expenses, over provision of expenses. Qualification. Second thing under qualification would be that you may not have sufficient audit evidence. Really, you would not have any audit evidence, as a result of which you are not in a position to consider the impact of that particular misstatement. But heart to heart, you believe that the misstatement will be a particular number beyond the materiality, but it will not turn the profit into a loss or a loss into a profit. It is something livable, but you cannot determine because you are not in a position to get the audit evidence. Under this circumstances also, you will give a qualified opinion. So we have talked about two instances of qualified opinion. When will you give? I'm coming to the matrix. When will you give a disclaimer of opinion? A disclaimer of opinion means that you are not in a position to understand the impact on account of the fact that you do not have an audit evidence. You are not given a proper audit evidence. You believe that in the absence of such evidence, the impact will not only be material, but it will be so material that the financial statements will result into misstatement, which could be pervasive, which means that your profit can become a loss or a loss can become a profit. It's a huge gap because of the fact that you do not have audit evidence. How can you give an opinion when you are not comfortable? So that automatically means that you need to disclaim and you need to say that we are not in the position to give an opinion. And this arises only when you do not have sufficient appropriate audit evidence of a matter which is material and which is pervasive. Now the last one, the danger one. You have all the information. After having all the information, you believe that the impact will be not only material, but will be pervasive, which will completely destroy the entire financial reporting. That means that you have to say very clearly that it is an adverse opinion, because your profit will become a loss or a loss will become a profit, or your profit will substantially come down because of the fact that you are very sure that the impact is very material and is pervasive, which means it wipes out the entire credibility of the financial statements. So these are the four circumstances under which a modified opinion will be required to give. Now, when coming to disclaimer, I'm coming to para of emphasis, 706. Para of emphasis is nothing else but the fact that there is an important item, there is an important disclosure, there is an important event which requires the attention of the users of the financial statements for them to appreciate and to understand the financial statements much better than what they are. Now, there can be two types of emphasis. One emphasis, which is generally the case, is that the management itself will make a disclosure in the financial statements of a particular matter, and you will want to bring out that particular matter. Say, for example, early application of an accounting standard, or an uncertainty in relation to a future litigation. For example, there is a litigation and you are not sure as to what could be the impact of that litigation on the financial statements of the company. There is an uncertainty. or there is a major catastrophe which has not only impacted the current profits, but that catastrophe will impact the future profits of the company. These are all determined, these are all assessed, these are all disclosed. However, you would want to invite the attention, and therefore, after the opinion paragraph, you will have a paragraph in your audit report called Other Matters. And Other Matters will have this particular emphasis where you are saying very clearly, without qualifying our opinion, we draw attention to this particular note. You are saying very clearly, without qualifying our opinion. That means the reader of the financial statements believes that this is not a qualification. This is something which the auditors are inviting attention. But remember one thing, please do not convert a qualification into a para of emphasis. I have seen many companies trying to put a para of emphasis, covering up the qualification because the client does not want the qualification. You are doing something wrong. If it is a qualification or a modification, it has to remain that way. However, para of emphasis is only from an understanding perspective. Now, what happens if the company has not given a note in the notes to accounts, and you believe that it's an important matter to be importantly disclosed in the financial statements? Doesn't matter if the company has not given a note in the notes to accounts. Under Other Matters, you will still mention very clearly that without qualifying our opinion, I would like to draw your attention on this particular matter where there is a catastrophe, the loss of which for the current year is 100 crores, and it is anticipated that this particular loss will occur in the future years. So automatically somebody doing a due diligence on the company, somebody doing a valuation in the company will take into consideration the impact of the future earnings and the future profitability. And this is exactly the significance of a para of emphasis where the auditors will be drawing the attention on an important matter. So this is all about para of emphasis. Under the auditor's report now, look at the two observations which I have printed in red. Now you are required to comment in the audit report of a matter having an adverse impact on the functioning of the company. I do not understand why government is giving the responsibility to the auditor of reporting of an adverse impact on the financial position of the company or functioning of the company. So this, please make sure that whatever qualifications you are reporting in the audit report, you need to take a proper stock of the fact that does it really impact the functioning of the company. And finally, again, any qualification or an adverse remark on the maintenance of books of accounts. If there is a qualification on the maintenance of books of accounts, it has to come in the audit report as well. Now there are some new standards. 701, 700 revised, 705 revised, 706 or whatever. Fortunately, these are all coming effect from 1st of April 2017. But the first one, 701, also coming in effect from 1st April 2017, is the one I mentioned in the beginning, that auditors will be now required to communicate the key audit matters in the audit report. So all your significant observations from 1st April 2017 will be reported in the audit report. I think this is something which I am not able to adjust and I am not able to understand, but that's the law of the land. Some of the other updates, just a couple of minutes, but this is going to be very important. Payment of bonus, as you all are aware. Payment of bonus, it is applicable. Now there is a Payment of Bonus Amendment Act. This is very, very important, please, and this is having an impact on your financial statements which you are going to audit. Actually, the increase has happened in terms of the eligibility amount. Earlier, the eligibility amount was 10,000. Now the eligibility amount has become 21,000 for the Payment of Bonus Act. Automatically, more and more employees will be covered. Even in the terms of the amount of the bonus, it has come out from 3,500 to 7,000 per month. Okay? So now over here, what is the new requirement? It says that you need to pay the bonus to your employees retrospectively from 1st of April 2014. This amendment has come now in 2015-16. How can you make a payment from 1st April 14? It technically has to be from the date on which this announcement has been made. Or even if I consider 2015-16, it's fine. Unfortunately, this is not properly dealt with. There are courts of law in different states, and please remember what I'm saying right now. If your audit is in a jurisdiction of a particular state, where the court has said very clearly that this is not to be provided from 1st April 2014, you are fine. The company will provide from 1st April 2015, and you are fine with that. But in Maharashtra, where most of us are working, and most of us have clients in the state of Maharashtra, Maharashtra has not decided this. Please do not rely upon the high court wordings of the other states. Each state has its own jurisdiction. I know many of you will feel differently, but the stand that has been taken by many firms and many professionals is, in the state of Maharashtra, there is no clarification. So you need to ensure that your clients provide from 1st April 2014 under the new revisions of the Payment of Bonus Act. In the event that they have not, now I'm giving you another view. A client will always argue with you. So what can you do? Can you qualify if he has not provided for 14-15? You may not want to. No problem, let there be a disclosure. In the contingent liability, the amount of 2014-15, let there be a proper disclosure in the notes to accounts also as to why this amount has not been provided for. And if that particular amount is material to the financial statements, in my personal view, I would like to draw the attention under other matters, saying very clearly that I invite attention to this particular matter whereby the company has shown under contingent liability and has not made a provision. The company will do so upon future clarity or whatever. This is requiring proper disclosures. But I can tell you all my clients or all our clients have been doing a provision from 1st April 2014 as far as Maharashtra is concerned. One of my clients came and told me, Karnataka High Court has a decision. I said, nothing doing. You cannot take that into consideration. So this is another important. Grace period given by the Employees Provident Fund Organization, that grace period of 5 days, which was there earlier, to deposit the money has gone off. This particular legislation came in fact from February 1st, 2016. So please make sure that in the event that there is a delay in the deposit of Employee Provident Fund for the month of January and for the month of February, then you need to report those delays because that grace period of 5 days is gone. So this is another very, very important thing because this is coming as a part of your audit report. And finally, I must say that there are certain disclosures under the Companies Act 2013. One of the most important is your trade payable. In your trade payable, there are two types of trade payable. Amounts payable to micro, small and medium enterprises and amounts payable to others. Friends, this is required to be shown on the face of the balance sheet. On the face of the balance sheet and not in the schedule inside or in the note inside. The distinction between trade payable to micro, small, medium and others has to be shown on the face of balance sheet. If you ask me the logic, I understand no logic from the government, but this is there. And then of course you have got the ICDS. There are certain disclosure requirements under ICDS. There is a requirement for having separate books of accounts for ICDS. ICDS impacts the current provisions of tax. ICDS impacts the disclosures. So you need to be completely conversant with the income computation and disclosure standards. These are very, very important. And finally, friends, I think I must say that please make sure that before you do the audit, you get the engagement letter signed off by the client. In 90% of the cases, you do not issue the engagement letter. In 90% of the cases, you may not even receive an engagement letter before the audit is signed off. Engagement letter has to involve specific issues in relation to internal control over financial reporting, management responsibility, auditor's responsibility, and the engagement letter also has to have certain paragraphs in relation to whose responsibility it is to detect the fraud and what is the responsibility of the auditor in terms of reporting the fraud above 1 crore. All that needs to be covered under the engagement letter. And please make sure, I am fully aware, with due respect to the profession, I am very much aware that many companies, many audit firms do not believe in engagement letter. Neither the client asks for the engagement letter, nor we provide an engagement letter. Please, there is a standard on engagement letter, there is a template on the engagement letter. Please issue such letters. In this, I just wanted to tell you one thing, that it is the future. There is a roadmap for banking, there is a roadmap for insurance, there is a roadmap for companies. These are very, very important provisions. You need to be completely conversant with the Ind AS, and you need to make sure that companies meet those criteria for Ind AS as well. Only in the case of banking companies and insurance companies, I would like to mention one important element. Although these are applicable from 2018 or maybe from 2019 in the case of insurance companies, please make sure that the boards are completely aware about the responsibility. The government has given the responsibility to the board for ensuring the roadmap of implementation and to determine from 30th September 2016 onwards. Banks from 30th September 2016 onwards will have to draw pro forma financials under Ind AS, which means that they will have to convert the balance sheet and the P&L account from 30th September on a quarterly basis for the internal purposes. And they need to appraise the management and the board of directors about how is it, how they are going to implement Ind AS, how they are going to work, and what could be the impact. This is something which requires continuous communication between the auditors and the management of the bank and the management of the insurance companies. Why is the government stricter with banks and insurance? Because these are public interest entities. Your money and my money is there in banks and insurance companies, and therefore government does not want to be a little loose and a little light on that front. So this is another very important thing. I would like to wrap up, but only with one favorite statement of mine. As far as auditing profession is concerned, friends, it is very difficult. It is no longer a pleasure. It is more of a hazard. Only in the last 2-3 years, even as an individual who have been in practice for 30 years now, I have been very, very concerned on everything that I sign. My clients ask me, Khushru, you are becoming stricter each year. I said, it's not me becoming stricter each year. It's the regulations which are becoming stricter. Disciplinary committee, QRB from the Institute of Chartered Accountants of India, peer reviews, SEBI inspections are just the beginning. National Financial Reporting Authority, who is going to be the watchdog of the auditors, is not yet constituted. It will be comprising of members not only from the profession, but from the bureaucracy as well. They may not even understand the audit. They may not even understand the difficulties of an auditor, under what circumstances an auditor signs the balance sheet with the gun on his head, given the timeline that there is a timeline for tomorrow. Financial statements have not even come today. I am sure many of you are facing the same situation. Management does not appreciate how much time the auditors get. They only say, मैंने तो आपको कल दे दिया ना, आप कल मेरे को दे दीजिए, 2 दिन काफी है आपके लिए, right? So these are the practical difficulties. I am the first one, and along with me, we have quite a few people in my firm who say very clearly, and go to the board and tell them that we've just got this day before yesterday. I don't think that you can do this. Another heads up I can give you, every documentation can be challenged in the court of law. Once you have a sign-off date, let's say that you have a sign-off date of 15th of June, you are technically required to sign off the financial statements on that date. I had made this point earlier also, and I would like to wrap up with this point. You will sign this off after 15 days because the notes to accounts and everything is not ready. What you are doing is that you are getting communications from the client on a daily basis. Sir, I have not received this. Arey sir, I have forgotten to check the creditors payable. Arey sir, please send me the cash confirmation. मेरे को तो आया नहीं, आप मेरे को भेज दो. Cash confirmations, balance confirmations have to be given directly to the auditor from the bank, from the respective divisions. It cannot be intercepted by the client. This is where Satyam happened. So friends, please be very sure that you need to make sure that whatever external confirmations are there, they need to come. These are basics of audit. I used to do this even 30 years back. We used to sign the envelopes, send the envelopes to the bank, and the bank used to give directly to us. I normally send one of my article trainees to the bank to get the confirmations directly from them if I don't receive. But I will not sign off unless I have every bank confirmation. So these are nuisance values, but these are important things. These are your defenses in the court of law. And therefore, please make sure that after the given date, even if you were to sign the balance sheet after 15 days, please make sure that you do not have a communication trail, because it can be concluded that as of 15th of June 2016, your signing date, you did not have enough audit evidence to sign off the balance sheet. If you did not have the audit evidence as of 15th of June, why are you signing off as of 15th of June? You may be signing in 15 July. But no, you will give the date of 15 June and rest of the audit is done between June and July. I may be sounding very difficult, I may be sounding very bookish, I may be sounding very technical, but I am very practical on that front. It's becoming more difficult. I can only tell you, I enjoy doing audit. I enjoy doing audit the right way, and I'm sure many of you who have been in this profession, you have been doing. Times are becoming very difficult. 60 to 70% of the time of the partner only goes in thinking about how the issues have to be resolved. What needs to be reported, what does not need to be reported. Be very fair. And in the audit, consultation process is most important. You have firms, you have other partners, you have friends, you have colleagues. Please talk to them, come to the decisions together rather than individual. We all consult with each other within the firm and come to the conclusion as to what is important, what is not important, what should be allowed, what can be disregarded, and what needs to be reported. So with this, I really appreciate, my apologies for all the people who are standing, but I can only give you one consolation. I'm equally standing over here. So thank you very much for a patient listening. Thanks.
Friends, we'll just take a couple of minutes more when the vote of thanks is presented. This may not till then. Kushlu, that was a wonderful summary of all the requirements that the auditor really needs to be aware of. It was woven very intricately, covering all the aspects, and I met all the people who are here are very push that they came today, and they'll remain push, I guess, throughout the audit season about everything they heard today. I request Chirag to make one announcement and propose a vote of thanks.
Only one key announcement. We have a lot of upcoming lectures, workshops and other element, but emphasis I would like to bring on is on the Foundation Day lecture of BCAs. We have the 68th Foundation Day on July 7th, 2016. And the session is on achieving sustainable, profitable growth on a perpetual basis by none other than the impactful speaker, which is Harsh Mariwala, the chairman of Marico Limited. So I would like to inform all of you and take the maximum benefit out of that session. The other announcements are a part of BCS newsletters. You can have a look at. We've also issued the BCS referential, launched the BCS referential today, and if you've not booked one, there's a desk available today if you want to book. Friends, the live recording or the video recording of this session will be available on the YouTube channel of BCS. The presentation, today's presentation, which was quite exhaustive and completing all the various elements of laws, will be available on the BCS website soon, so you can download from there. We at BCS also follow a risk-based approach while selecting the lectures. And today, I would like to thank Khushru for being one of the preventive controls for all of us and enlightening us on the various acts and sharing his in-depth knowledge on various regulatory requirements. I, on behalf of BCS, would like to thank you for taking time out of your busy schedule and sharing your knowledge of Caro, Indias and various elements. So thank you, Khushru, for an amazing lecture today. Thank you.